Good morning, everyone. My name is Damaris Mukulu, the head of brand and marketing at Genghis Capital. Welcome to the Genghis Weekly Investor Briefing. We are glad you could join us today, Monday, October 18th. The Genghis Weekly Investor Briefing is meant to walk you through the financial markets, that is, give you insights into the macroeconomic, fixed income, and the equities market. The aim is to help you take the guesswork out of investing by giving you sound advice from our research team. So today we have Melody Ndanu, who's going to be taking us through the presentation, along with a sharply dressed Wesley Manambo. It's good to see you guys this Monday. The Genghis Weekly Investor Briefing is interactive, so we urge you to use the Q&A tab. Depending on the device that you're using to join us this morning, this could be at the bottom or the top of your screen. So during the presentation that they'll walk us through, just send in any questions related to the financial markets using the tab or the Q&A. I see Kevin Kakuti has already sent a message on chat. So if you could just use the Q&A tab, it makes it easier to make sure we don't miss anyone's question. I think that's just about it. We're super excited to start our Monday morning on a high. So over to you, Melody and Wesley. Thank you.
Thank you, Damaris. Good morning, everybody. Just give me 1 second to share my screen. Is it visible?
Yes, it says you've started screen sharing. I'm waiting for the PPT to show up.
Okay.
Yes, I can see it now.
Okay, thanks. So we'll just have a look at what happened in the market. Let's have a macroeconomic review first. So last week, EPRA, that's the Energy, Petroleum and Petroleum Regulatory Authority, it cut fuel pump prices after they reinstated the fuel subsidies. We saw that in September, the prices went up quite a bit, actually the highest in record in recent history because of the removal of these subsidies. So in Nairobi, kerosene experienced the largest drop to 103.54 shillings, with petrol and diesel coming in at 129.72 and 11.60 respectively. So these effects will have just a marginal decline on the fuel pump prices, and we expect that this will stay the fuel inflation levels, but they'll still be elevated. September was about 11.1%. So following the public uproar last month over this fuel increase, the National Assembly last week, they backed a report that sought to reduce the fuel and cooking gas prices through tax amendments. So the report proposed the reduction of petroleum levy from 5 shillings and 40 cents to 2 shillings and 50 cents. And they also sought to have the VAT on LPG slashed from 16% to 8%. So essentially, these steps are supposed to reduce pump prices to about 12 shillings per litre. However, now when this is done, the government will be left with a funding gap of about 37 billion. So most likely the National Treasury will have to prepare a supplementary budget to factor in this deficit. And now they might also have to look at either widening the tax base or just finding another way to raise this revenue. So as looking at this effect in the capital markets, we expect that the yields of fixed income securities will continue to edge up higher because investors will be pricing in inflation in the near term. So although EPRA reduced the price of fuel on one hand, on the other hand, they reviewed the fuel cost charge upwards. That's the one for electricity to cushion Kenya Power. So it went up to 3.97 from 3.88 for every unit consumed. So the effect of this fuel cost charge will mean that electricity prices will go up. And it's mostly due to FX adjustment because the Kenya shilling has been facing some pressure since around June. So you see that there's it's like giving with one hand and taking with the other. So we'll just wait and see the proposals that were given that electricity prices are supposed to come down by around 33%, the tariffs. So we're just waiting to see how that will come about, the electricity costing formula, and just the reforms that are going to go on with Kenya Power. The other thing was that IMF downgraded the GDP forecast for Kenya, so it trimmed it down to 5.6 from 6.3 previously. So this was according to the updated World Economic Outlook for the month of October, rather, sorry. So in the previous projections, they had the IMF had seen the economy rebounding at about 7.6, which was quite impressive, then cut it to 6.3 and now 5.6. So they say that the vaccine access remains principally the main driver of the global economy. We saw also that's what the World Bank said in their previous reports. They had released it, I think, last month. So we've seen that vaccine access is going to be a very key factor in how economics grow in the near term. So World Bank had revised it to 5%, and CBK it's at around 6.1%. One second, please. So next, we're going to look at the money supply statistics. So according to the data that was released by CBK, liquidity for August came in at about 6.1389 trillion. So this is a rise of about 12.9%. So the rise was in line with the overarching theme during that period of heightened liquidity in the market. So M1, which is coins and notes in circulation, as well as demand deposits held by non-government and non-bank demand deposits, you can say these are called deposits. They rose 9.3% year on year to 1,810.4 billion, let's say 1.8 trillion. M2, this is broad money supply, which is basically now M1 plus long-term deposits. Now these are now like fixed deposits and savings deposits in banks. It rose 8.5% to 3.45 trillion, with foreign currency deposits hitting 771.1 billion. This is a 16.1 increase rise year on year. So looking at these statistics, we have the opinion that investors are converting their wealth to these hard currencies. This is the dollar as a hedge against the depreciation of the local units, which has been under pressure, as I said, since around June. Also because of the increased demand from importers. M3, which is extended broad money, which is M2 plus the foreign currency deposits hit 4.22 trillion. So notably, non-bank holdings of government paper witnessed a jump of about 20.6%. So now we believe that this is because investors are shifting to this asset class as they prefer to hold risk-free assets. These are government securities because of the ongoing uncertain economic environment, and also because now we're heading into the political scene next year, the elections. We might find that people will shift from equities now to fixed income because they're looking for that stability. Looking at the private sector credit growth, it's still punching below its weight at 7% in August. I think CBK had a target of around 8.5%, I think, in about September. So you can see it still has some way to go, and it's been struggling to cross this double-digit figure since June 2016. Now, also because the risk-based pricing models are yet to be approved by CBK, and it's more of an open-ended request. There's no timeline of when it will be approved. We might see the private sector continuing to be crowded out by the government's increased domestic borrowing. So in theory, when there's more money in supply, it indicates low interest rates, more investments, and that there's more money in the hands for customers to stimulate spending. Additionally, businesses are hypothetically expected to order for more raw materials and raise employment levels and increase funding. But as we've seen, the credit private sector credit growth is still quite subdued. So it kind of doesn't go together with the theory, let's say. So usually bank regulators now like CBK influence money supply available to the public through like the CRR, that's the amount that banks are supposed to hold. We saw that when COVID hit, the CBK revised it downwards from 5.25% to 4.25%. So this was meant to release capitals for banks to stimulate lending. But as you've seen, private sector credit growth is still a bit wanting. So we'll see what happens in due course. Looking at the fixed income segment, before we go to the fixed income, just an update on the budget process. So the National Treasury held the sector hearings for the financial year 2022-2023 budgets, which was on the 13th to the 15th of October. Additionally, the final budget review and outlook paper was published after it was passed by Parliament. So the report basically looked at what happened in the full year 2020-2021 and it highlights the budget expectations for this coming financial year. So what's going to happen, because it's been hastened, it's supposed to be completed in time before the elections actually are done. So the government is aiming to lower the fiscal gap from around 7.4 to 5.7. So they are planning to finance this using foreign financing of about 367 billion and 408.1 billion of domestic borrowing. So this is much lower than this current financial year's borrowing of about over 600 billion. So the government is looking at collecting about 17% of GDP as tax collection. Basically, they say this is due to the economy reopening and activities picking up, that you're going to see more tax revenues being collected. They're also looking at diversifying the tax base. So now, once this sector budget proposals have been finalized, it will give way to the draft 2021 budget policy statement. So now this will give the ceilings of the overall budget expenditure, that's national budget and also the county governments. So now moving to the fixed income, the secondary market participation fell 17.7% week on week to the close of the week to 10.3 billion. So market interest was mainly, as the previous weeks, just been on the longer end of the yield curve, as well as on the infrastructure bond segments. It could also be that the lower turnover was also due to the public holiday that was on Monday. For T-bills, they reported an improved performance of 74.3%. That's an improvement from 40.9% the previous week. Yields have continued to go up, now an average of 0.46% year to date. So we believe that investors are investing in these shorter term securities as the political scene continues to heat up on the backdrop of the upcoming election cycle. So looking at liquidity trends, so the market is slowly becoming more liquid. We've seen that it had been quite tight after the closure of the bond in September. That was the infrastructure bond. So it's witnessed improved liquidity as of last week due to the closure of the CRR, that's the cash requirement cycle, on the 14th of October. So this sentiment of improved liquidity is also supported by the contraction of the interbank rate. That's the rate that banks lend to each other. It went down to about 4.62%, about 173 basis points week on week drop. So in regards to open market operations, the CBK mostly stayed out of the markets. However, they came in to mop up liquidity, about 20 billion at the tail end of the week. So for this coming week, we might see some increased liquidity because there's some bonds that are paying coupon payments as well as there's partial redemption. So it's going to be around approximately 20 billion of new money being injected in. And also that there are going to be some T-bills that are maturing. Looking at government debt levels, it's ahead of the curve. 280, we approximate it's about 289.4 billion versus a prorated figure of 215.3 billion. That's 45.1%. That's including the overdraft at the CBK. So for the macroeconomic and FI calendar, mostly there's nothing much going on. Just the 91, 182 and 364 day T-bill options. For the fixed income trades, we are recommending a buy on FXD1 2021-25 at 13.78 to 13.8 levels. So the logic behind this is that it's the fixed rate bond is paying the highest coupon bond in this series, that is net of tax, and its yield to maturity is yielding a higher return on holding. Also, it's going to pay a coupon payment on the 8th of November 2021. So that's it from me at the moment. So I'm going to hand over to Wesley to take us through the equities segment.
Thank you, Melody. Good morning to you. The market was mixed as signaled by the benchmark indices performance. The Nairobi All-Share Index peaked 1.7% week on week to 178.86 points, while the NSE 20 share index dwindled by 1.1% to 1970.44 points. That said, a bit bounce declined as signaled by the decline in turnover that came in at 2.1 billion. Looking at the week's top movers, Nemuruti led the pack with a 10% week-on-week gain. Standard Group, Safaricom, Olympia, and East Africa Portland registered 5%, 3.5%, 2.6%, and 2.5% week-on-week gains, respectively. The Bank of Kigali Group led the week's laggards, shedding 6% week-on-week. Britam, KPLC, Kengen, and Everready shed 5.5%, 5%, 4.4% and 4.4% week-on-week respectively. Just a comment, Safaricom's week-on-week performance shows a bounce back from some sort of mean reversion now that the market has an excitement in anticipation for their half-year results that are scheduled for 10th November. That said, we expect M-Pesa revenues to register a stellar run on the back of a strong growth in the 30-day active M-Pesa users, also coupled with the lapse of zero rating transaction. It also goes without saying that the M-Pesa Super App is expected to ubiquitize M-Pesa usage with its ease of transaction and the incorporation of mini apps, which will definitely translate to revenue growth. We also expect some more color on the Ethiopian venture to chaperone the results, as we get to see when they'll start some projections of their capex and earnings over time. A glance at the week's foreign participation indicates that foreign investors accounted for 68.2% of the week's turnover. They clocked net outflows of 87.8 million, mostly bearish on the banking stocks while accumulating on Safaricom and EABL. We anticipate to see heightened activity on banking stocks in the coming weeks as we close in on the third quarter earnings that are scheduled for next month. East African Cables released their results. They reported a 2 shillings and 15 cents loss per share for the year ended 31st December 2020. Their top line grew 13.6% year on year, while revenues came in at 1.8 billion. Cost of sales were reported at 1.2 billion. That's a 14.2% year on year growth. This translated to gross profits of 565.2 million. The counter registered a loss of 753 million and its balance sheet shrunk 5.5% year on year to 5.9 billion. Looking at their first half results for FY21, the numbers show that their revenues grew by 10.8% year on year, despite a sharp fluctuation in metal prices. The bottom line was not as rosy as the counter registered a loss of 229.3 million, which plunged its EPS in the negative territory. It goes without saying that the exchange rate fluctuation and volatility in prices of raw materials will be some of the major headwinds the counter will face in this financial year. We expect the cost of sales to remain elevated on the back of the escalation of metal prices that has seen a dampening of demand in 1H21. Also, as per the London Metal Exchange Index, which follows 6 metals, that's aluminium, copper, zinc, lead, nickel, and tin, the prices of metals are seen to be at an all-time high against the backdrop of elevated cost of energy, which is suppressing the production, resulting into shakeups in the demand and supply metrics of the metals. On the corporate calendar, we have Safaricom's half-year results scheduled for the 10th of November. To you, Melody.
Thank you, Wesley. So I'll just take you through the financial sector, rather the banking stocks and the insurance stocks, how they've been performing. So across both counters, there were just marginal drops this week. However, NCBAs rose 2.8% week on week to 25.75 shillings, and BK Group shed 6% week on week to close at 28.2 shillings. So in the insurance counters, CIC insurance dropped 4.3% week on week to 2.69 shillings. The rest were relatively negligible declines, with Britam remaining flat. So just looking at the news in the week, so the CBK Amendment Bill 2021 passed the committee of the House stage. So the National Assembly on last week Thursday, they passed the amendment bill, which gave provisions for now the regulation of the licensing of digital lenders. So now it's waiting for the third reading and finally for assent by the president before it becomes law. So while CBK will not enforce any capital or liquidity rules on the lenders, now the CBK now has substantive powers to take on this unregulated industry. So one last minute amendment was to require digital lenders to provide key information while applying for licensing from the CBK, including a certificate of incorporation. Players in the digital lending space will have 6 months to apply for licensing from the date CBK publishes this required regulations. We've seen that these digital lenders have come under fire, especially after the unauthorized use of people's personal information, as well as listing individuals haphazardly. In short, there was some like Wild West behavior in this industry. So the CBK has come to rein it in. So the CBK is going to be allowed to set parameters for the interest rates charged by these digital lenders. And it will also have the liberty to revoke licenses of players who breach the Data Protection and Consumer Protection Act. So meanwhile, digital lenders will now be allowed to go back to listing on CRB, marking the return of the credit information system sharing system after it was suspended last year. So yes, this is supposed to protect also the borrowers from the debt shaming tactics that we saw that were used to recover loans. Secondly, bank profits rise in the 7 months from January to 113.4 billion. So as the data from CBK shows that the pre-tax earnings in the 7 months hit 113.4 billion. This is a 53.2% rise year on year. And it's also gone ahead of the 112.8 billion posted for the full year of December 2020. So that paints a really rosy picture for the banking sector. We might see some really impressive pre-earnings in this financial year. So the jump came in a period where banks increased lending and cut the size of non-performing loans, mostly due to repayments and also auctions, also due to the easing of the restriction and the rollout of the vaccinations, COVID vaccinations this year. So, so most banks reported impressive growth this year in quarter 1 and quarter 2, mainly because of the reduction of loan loss provisions, as well as boosting their capital base, either by withholding dividends or paying out a small amount, as well as getting additional capital from institutions like the IFC and these multilateral banks. So banks also choose to invest in risk-free assets rather than to lend to customers. And that's why we've seen that the liquidity levels of banks are quite elevated at about 57%, which is way higher than the minimum requirement of 20%. So we can see that banks are still cautious on lending, and they're preferring to give the money to the government. Now the thing is, the yields that are earned from lending to the government are much lower than what it would earn if they actually lent out to SMEs. So, but however, this is mostly because the risk-based models, as we said before, they haven't been finalized yet. So banks are still cautious about lending. Thirdly, UAP is offering funeral cover to urban dwellers. So the households in urban areas will benefit from funeral cover as low as 570 shillings annual premium. This is following a deal by UAP and Kenya Urban People's Association. So it's going to target chamas, church members, welfare groups, alumni associations, as well as resident community associations in towns like Nairobi, Mombasa, Kisumu, Eldoret, amongst others. So we've seen that many insurance companies are now coming up with diversified products as they seek to increase their revenue base. Lastly, though this is not, it wasn't reported last week, it was a bit prior, but it's just something good to note. So a local daily paper reported that the National Treasury is going to shift the issuance of a mobile-based government bond program, that's Emakiba, to the CBK, away from NSE and CDSC. So the bond fails to take off mainly due to poor timing, low understanding of the product that led to undersubscription. So the rate was of performance about 24.7%, with only 247 million raised out of a target of 1 billion. So we see that this, this latest policy shift is supposed to revive the performance of the debt instruments and also to deepen the treasury bond market and also promote financial inclusion. However, in our opinion, this might be a negative move for the capital markets, because it's essentially strengthening the hand of CBK in the capital markets at a time where their role is supposed to be mainly focused on the monetary policy. So until it is finally, like when we see the actual document saying that it is going to be transferred, we believe that essentially this is going to be a negative to the capital markets. In summary now, the equity trading idea for the week is just a hold on equity group holdings. So the management is looking to transform its trade finance business and also offer derivatives in DRC. We've seen DRC has been performing well, and it's actually, I think it's taken over the Kenyan subsidiary side. So it's a wide customer base and distribution channels. The group is interested in setting up a insurance business unit with the possibility of offering credit cross-border insurance. We've seen that the insurance penetration in Kenya has been quite low. It's lower than 3%, and it's actually been going down. So we'll see how they'll manage to contravene that. It's also anticipated that its performance will further cement pre-COVID dividend payments. And we've seen that they had withheld dividend payments last year, and they had passed in their AGM that they're going to have a dividend policy going forward. I think about 30 to 50% of profit. So that gives us the theory behind this trade idea. So that brings us to the end of our presentation.
Thanks, Melody and Wesley. That was interesting. I've seen two questions come in since you started the presentation. We'll start with Kevin Kakuti's question. He says, is EABL's domestic medium-term note open to individuals? What's the purpose of companies doing term papers, and what's the benefit to investors? And is there a tax component to this term note?
Let me pick it, then Melody will add high-level thinking on it. Overview of medium-term notes. Medium-term notes are just an alternative source of income. To the best of my knowledge, they come in handy when credit ratings are not so favorable to acquire what I'd call cheap loans, and also when the interest rates are deemed to be too high. To the investors, the interest rates are usually attractive, given that the notes are attached to a high risk factor in comparison to other fixed income assets. Normally, the higher the risk and the longer the time horizon, the higher the interest rate attached to it. Now to the EBL medium-term notes specifically. I think EBL is seeking to raise 11 billion, and that's shortly after they retired their 6 billion term note on the 28th of June, I believe. They said the early redemption was averred as part of their balance sheet and cost of funds optimization. And this 5-year tenor, which has an interest rate of 12.25%, comes in line with our projection of a near-term corporate bond issued by the counter. And the rationale behind this was that there was a contemporary high cost attached to the alternative sources of income in light of the pandemic impact on the macroeconomic environment. The note carries a tax aspect to it, so for that. Quote unquote, they said all payments in respect to the note will be made with deductions of withholding tax, other taxes, duties, assessment, and government charges of whatever nature imposed or levied by or on behalf of the government of Kenya. Melody, do you have something to add?
Oops, sorry. Thank you. I think you've covered everything, Wesley.
All right, then. There's a question I've seen from Sharon, who's concerned about Jacuzzi. Sharon, yes, there's an issue with some bugs on the Android version of Jacuzzi, but the IT team is looking into it. In the chat box, I have shared with you 2 email addresses. If it's something involving your portfolio or you want to trade and you're unable to, you can reach out to the 2 respective client relations team. So if it's regarding Helaimara, please reach out to the AM client relations at Genghis Capital. And if it's regarding your share trading account, please use client relations at genghis-capital.com. If there are other attendees facing similar challenges and you already have an account, I'd like to remind you that there is an alternative. There is the online share trading portal that allows you to trade on the NSE listed stocks the same way you do on the application. The only difference is that you would do it on your web browser. So simply go to the Genghis website. If you just Google Genghis Capital, go under resources, then you will find a link for the OST. So you'll be able to trade using that. If it's for Helaimara, again, you want to buy units or you want to send in withdrawal or investment instructions, you can use the USSD *671#. So those are just alternatives in place as the IT team looks towards fixing the issues that have arisen on Google Play. The Q&A tab, where Kamau sent in 2 questions. His first is about the MTN IPO that's been getting a lot of coverage, the MTN IPO in Uganda. He's asking if it's a good buy for Kenyan investors. And then his second question is, what explains the continuous erosion of cooperative bank shares? So who would like to tackle those questions?
I can try, and then if Wesley has something he can add on that. So for the MTN IPO, unfortunately, we haven't valued the company, so we can't give a straightforward if it's a good buy or not. But what we can do, we had looked at the various factors that that affect the company itself. So that there's some positives. The subscriber base increased 12.3% in 2020 to 14.2 million subscribers. And also Uganda has a population base of around 46 million. So there's a possibility of a small rival. This is Africell, that they say they're quitting the market, so they can acquire more subscribers from there. So given the growing customer base and the large population base, we see that there's possibility of expansion. Also, active data users went up, mostly due to high online demand resulting from the effects of COVID. Also, they have the cost efficient program that saw the EBITDA margin go to 49.5%. Also, they are targeting to pay out 60% of annual profits after tax. So that means that if somebody wants to get in on this IPO, they're assured, or it's highly likely that they will get dividends every year with this very impressive payout ratio. The MTN group is also planning to divest from the Middle East. They had announced it in 2020, mostly due to the volatile geopolitics there, as well as problems with Western sanctions. So in our view, we believe that this will mean that Africa will have more resources and funding to fund their capex and investments. Now, the risk side now is that MTN's telecommunication licenses, permits, and frequency allocations are subject to finite terms, and their ongoing reviews and periodic renewals. There's also the issue of being exposed to changes in Uganda laws. Like now, you see that they made it compulsory for them to be listed. Also, the regulatory costs that the company has been incurring has been on the rise. So also there's the issue of limited spectrum. So this impacts the required capex, affecting the network expansion and increases the company's cost of doing business. There's also the antitrust and competition laws that favor increased competition. So we might see that in the event that it's viewed that the company is enjoying a significant market share, that some moves might be made to kind of rein in that. There's also the issue that they have exposure to SIM box frauds that usually eats into revenue. So those are just of the basic highlights that I would say would need to be considered. But however, on the other hand, we saw that the Safaricom IPO was done. The share price was quite low. The entry level was good. And we've seen how far Safaricom has come. So you could say, you can use that as a base. However, there are very many different factors. Safaricom is not the same as MTN, though they operate in the same industry. So in our opinion, it's best that somebody looks at these factors before considering to buy the MTN IPO. So for Cooperative Bank share price erosion, so I would say that maybe it's investors are viewing that the bank is a bit more preserved, conservative compared to KCB and Equity. We've seen that they've been posting some really impressive results. They have let go of their loan loss provisions. They've also expanded regionally. However, Coopbank is more conservative. It's not looking to expand outside Kenya anytime soon. They also acquired Kingdom Bank just so that they could mostly focus on the asset financing to get better market share from the Kingdom Bank. So you can say that it could be that Cooperative is not making market moves per se, quote unquote, as compared to KCB and equity. That could be a reason for the investor sentiments and the share prices going downwards.
Does that mean that the COP counter itself is undervalued? Would it be a potential buy?
For me, I would say it is. It has some good programs it has set aside, like also the the mobile banking loans platform. They have a really good yield and it's based on check off. So that means that the risk of credit default is low. They also have the program that they have the Project Kilele and also Soaring Eagle. And they're also looking to roll out a system to improve their efficiencies. So I still believe that there's still value in Copbank. Though we've seen this year, they still have elevated loan loss provisions as compared to KCB and equity. So you can say that they're just being more conservative.
Sure. Okay, thank you so much for that, Melody. I want to take the question from Titus regarding KCB because you've mentioned it before. So Titus is asking, what is your recommendation on KCB group stock? Will it improve or do you recommend a hold or sell? Also, the market has been on a decline. Is it a price correction or is it a cyclical thing? So a continuation on the bank stock discussion.
So for KCB, I would say it's a hold. So I think that I can also combine it with Kevin's question on the decline of shares of value of banking stocks. Mostly it's due to price correction. We saw that they really rallied when they posted the second quarter results. And now it's just the market correcting just from those highs of investor sentiments due to this. For KCB, we've seen that they are looking to, I think they have completed acquisition of the Rwanda bank, that's a BPR, and they're going to integrate it with KCB Rwanda. And also they're looking to acquire a bank ABC in Tanzania. So for me, I believe this is a hold. We're going to see some good performance coming from KCB. They say that the restructured book is performing well, and also they're going to launch the Vuma lending platform, which is supposed to have more cost efficiencies. So for me, I believe that for now, KCB is a hold as we wait for the third quarter results.
Okay,
and sorry. Oh, in regards to the banking stocks, they went down mainly due to price correction.
Perfect. So I believe you've also handled Kevin Kakuti's question. So that's fantastic. I don't see any other questions in our chat or on the Facebook Live or on our Q&A. So I think it's safe to call the session to a conclusion. Thank you for the market insights and for the recommendations for this week. All attendees, we remain available on our social media platforms and also the email addresses I've shared on the chat box. So if you have any questions or concern, you can always reach out to us. I think if you've ever used social media, you know we're quite responsive. So we're happy to engage with you. Thanks, Melody and Wesley, for your awesome presentations today. I don't know where Wesley is headed to. He needs to tell us. Wesley, where are you going? Whether there's a problem with looking sharp on a Monday.
He'll tell us.
Let's just say the weather didn't behave on my polo shirt.
Okay, no, it's okay. If the alternative to polo shirts is a suit and tie, you're raising the bar quite high. So super proud of you guys. So everyone else, thank you so much for attending. We'll see you next week. That is October 25th. Remember, there are only 6 more sessions of the Genghis Weekly Investor Briefing left in 2021. So we look forward to wrapping up with you guys. Have a good week and see you then.
Thank you, Damaris. Have a great week ahead, everyone. Thank you for making time. Hey, Jesus.